Let's just dive right into this explainer. Look, if you've ever felt like the market is literally playing games with you, stopping you out right before a massive rally or dragging you into a breakout that immediately crashes, trust me, you are not alone. Today, we're going to unpack a 100-year-old forensic framework to track the hidden footprints of smart money in highly volatile assets like Bitcoin and gold. This isn't about guessing, it's about reading the market's true intentions.
To actually demystify these charts, we have to start with this brilliant metaphor from Wall Street pioneer Richard Wyckoff. Way back in the early 1900s, he realized he really need to view the market as a singular, unseen antagonist. He called him the composite man. This composite man sits right behind the scenes, manipulating the market to your disadvantage if you don't understand his game. But if you learn to play alongside him, well, that's where the massive profit is.
So, the absolutely crucial point here is that this composite man represents the combined force of massive institutional players, the whales. Think about it logistically for a second. These whales can't just buy or sell hundreds of millions of dollars of Bitcoin or gold all at once. No way. If they did, their massive orders would instantly crash or spike the price, ruining their own entries. Because of that, they absolutely must operate in total stealth, executing their strategies over days, weeks, or even months just to stay under the radar.
Here's how we'll systematically track this composite man today. First, the 3 universal laws. Second, accumulation and markup. Third, distribution and markdown. And finally, Wyckoff strategy and psychology. Okay, moving into section 1, the 3 universal laws.
These 3 laws rule the market, period. The first is supply and demand. When demand outpaces supply, prices go up, and vice versa. Simple enough, right? The second is cause and effect. This tells us that a massive trend doesn't just happen out of nowhere. It requires a cause. Basically, the longer the sideways preparation by smart money, the greater that resulting price explosion is going to be. And the third is effort versus result, which is where we compare trading volume to actual price movement.
Now, comparing volume effort to price result acts kind of like a lie detector. When effort and result align, like high volume driving rising prices, the trend is healthy. But here's the kicker. Notice the divergence. If you see high volume, but the price is barely moving, that is a glaring warning sign. It's telling us that someone huge is quietly absorbing supply on the other side of the trade, completely masking a potential reversal.
All right, section 2, accumulation and markup. Let's look at how this cycle actually begins.
During the accumulation phase, which usually kicks in after a brutal markdown, we see this brilliant, almost cruel juxtaposition. On one side, you have the public. The media is overwhelmingly negative. Terrified retail traders are panic selling their gold or Bitcoin, and everyone is declaring the asset completely dead on social media. But on the other side, smart money. They are patiently, secretly absorbing all of that supply. They intentionally keep the price trapped in this boring, sideways range, just letting retail exhaust themselves in fear.
And this brings us to the ultimate bear trap, the spring. This is the absolute hallmark of the accumulation phase. The composite man pushes prices down below obvious support levels one last time. Why? Because he knows that's exactly where all your stop losses are hiding. By triggering those stops, he creates a sudden flood of liquidity, allowing him to scoop up the remaining supply at absolute bargain prices. Think back to Bitcoin dropping near $15,000 in late 2022. That was a classic spring that shook out the weak hands right before the real rally began.
Once the smart money has soaked up all the supply and completed that spring, they hit the gas. They initiate the markup phase. You'll see a definitive sign of strength as the price breaks out of the accumulation range. And because there's literally no supply left to hold it down, the asset enters this beautiful, virtuous cycle of higher highs and higher lows. The media catches on, retail traders eventually FOMO in, and they drive the price up exactly as the composite man planned.
Which leads us into section 3. Distribution and markdown.
Up here in the distribution phase, the psychology completely flips. Now, the public is blinded by greed. They're buying every perceived dip, ignoring all the risks, and just fueled by euphoric news. Meanwhile, what's the composite man doing? He's quietly unloading his bags. He actually needs that retail buying frenzy to act as the liquidity for his massive sell orders. So he keeps the price moving sideways at the top, handing off his inventory to the exact people who think the rally is never going to end.
So beware the upthrust. Just like the spring was a trap at the very bottom, the upthrust is the trap at the top. It's a highly calculated false breakout above resistance, completely designed to fool retail buyers into thinking a massive new leg up is starting. Think of the double top of the 2021 Bitcoin rally that felt so unstoppable. In reality, it was just the composite man providing the final liquidity trap so he could exit his remaining shares before aggressively tanking the price.
Once the smart money is out, the floor gives way, and we enter the markdown phase. You'll spot a sign of weakness as support violently breaks. And here is a vital psychological reality to remember. Fear is a much stronger, much faster emotion than greed. Because of that, the markdown phase is almost always far more violent, brutal, and rapid than the uptrend ever was, defined by heavy selling pressure and just total public panic.
Let's zoom out and look at how this builds chronologically. You can clearly map out how this exact psychological cycle repeats endlessly. Accumulation takes months of patient base building. The markup uptrend takes weeks to months. Distribution at the top is often way quicker, lasting just weeks. And the markdown? Well, that can be over in a matter of days or weeks. This cycle plays out everywhere, from legacy stock markets all the way to modern volatile crypto assets.
Let's wrap it up with Section 4, Wyckoff Strategy and Psychology.
At the end of the day, the absolutely crucial point here is risk management. You have to stop guessing. Never trade in the messy middle of a sideways range where the composite man is just shuffling supply around. You wait patiently for structural confirmation. If you spot a spring, that's your high probability buying opportunity, and you place your stop loss tight just below that spring's low. Conversely, if you see an upthrust, that's your signal to sell or short, placing your stop right about it. Whatever you do, never let FOMO override the true story that volume and price are telling you.
So now that you know exactly how the smart money operates and how they manipulate supply and demand, it's time to put these skills to the test. Open your charts right now. Look at the volume, look at the effort versus the result, and tell me, what phase do you think Bitcoin is really in today? Are we quietly accumulating, marking up, or is the composite man setting another trap? Let that sink in as you watch the markets this week. Thanks for joining me on this explainer, and I'll see you next time.